so we've identified a broad structure with pullbacks. Very broad, very basic, but it's nice to sometimes give your trading style a little bit of boundaries and a little bit of focus. So we've got 1, 2, 3. So how do we get involved in each one of those pullbacks? Now, generally speaking, the probability of the market continuing diminishes the number of pullbacks you've had. Again, simplifying things, but as I said, if you're on the 3rd, 4th, 5th, 6th pullback, you really want to be careful because that trend has been going a long time. You know, it's due some sort of unwinding. It's due to perhaps pull in a few sellers. So the first pullback you get is generally going to be the shortest. It's generally going to be, in terms of time, it's generally going to be the shortest or smallest in terms of number of ticks or number of percentage wise if you want to on a daily chart, and it's going to be the one that has the most probability of working. Now, obviously, the first scenario you have to have, or the first filter you have to have, is that you've identified momentum. In this case, we've seen a good opening drive on the DAX and it's starting to pull down lower. How are we going to time the long entry on this pullback, and where exactly are we going to put our stop? Again, personal experience here, no advice given, just use it as whatever, whether you want to use it as a guide or whether you want to do whatever you want with it. This is just my approach to it, and it's kind of worked okay for me over the years, so and I'll share it with you now. The idea for me is that I want to see a couple of things. I want to see the strength of drive. The other one I want to see is how far back, and we talk about this quite a lot in various scenarios, how far into the initial drive does the pullback excursion happen. So if that's the initial drive there, you know, how far does this encroach into the drive territory? Generally speaking, if we start going below this 50% level into this zone here, I'm not interested. For me, that becomes more of a choppy trading environment, and I'm going to use a different strategy. I'm not going to use my trend strategy. I'm going to be a little bit more cautious. Not to say I'm not going to take a long, but I'm not going to use the same parameters as I would if I was trading from a trend environment perspective. So let's have a look. A couple of ways we can do this. We can frame it and say, yes, listen, we've got a good drive, hasn't pulled back much, right, I'm still looking to go long. We can get all traditional on it. Let's drag that out the way now that we've seen that. Remove that. We can get all traditional and all textbooky, which works absolutely fine because textbook stuff does work in the right environment. It's frustrating when people try to use this in the wrong scenario. You can just trade your double bottom. You're looking for some support. Okay, you've got to have 1, your drive, 2, you're encroaching to the drive territory, not too much. Those are the two things that people miss out when they talk about this thing. But once we've got those and we've filtered and say, yep, okay, now we can look for a double bottom pattern on our daily or on our 1 minute, whatever it may be. And this is exactly what you get. Little wicks, support, just anything that identifies support, and we get it. And of course, obviously, this is a good example from this perspective because it rips up a good 40 ticks from there. Which is fine. They're not all like that, but the general thing, a consensus is you're trying to look for at least a retest of the high. And if you're on a genuine trend, you've caught a genuine trend, you're going to get second and third counter trend moves. And if you're on the first pullback you're going to have a lot more meat in the trade. So that's one way of doing it. Doing that, looking for literally traditional double bottom on the move. Again, making sure you've got the filters in place initially. Now the second way of doing it is to draw yourself a downtrend line. Very simplistic, but again, you've kind of done all the hard work with the filtering process, and you're looking to take this trade as soon as that downtrend line breaks. That is it. So it's very, very systematic. Got strength, pull back, downtrend line goes in, you're long here, your stop goes under here. That's it. Very systematic, and you're looking for it to break the high. Very simple, no thought needed to do that. No need to look at price action or anything. Generally speaking, that happens quite a lot. Sometimes it's going to be a bit scrappy, in which case it's a bit difficult to do, but generally speaking, you can draw this kind of downtrend line and then take it when it comes out. Obviously there's a little bit of heat in this example. No example's perfect. Often you'll get it driving straight out, but ultimately the thesis of the trade works, and that works very nicely. Okay, what else can we do? Another thing we can do is we can stick on a moving average. Yes, this is kind of simplistic, guys, but as I say, and at the risk of repeating myself a little bit, where's the input? Exactly that. At risk of repeating myself, trading can be simple as long as you're doing the right thing at the right time. If you're getting involved in an uptrend by buying pullbacks, that's the right thing to do. You've just got to try and frame that as best you can. Don't need to be perfect. If you're trying to fade highs on a trend environment, then you're kind of not going to work for you. So another way of doing it is just to be very simplistic and put something like a 20 period. I find a 20 period works very, very well. In this scenario, it's not so clean. Admittedly, it's not so clean, but there's still not much heat. So you're buying as you just test that 20 period. So it would be 12,753 in this scenario, and you've got to kind of use an arbitrary stop on this. You've got to kind of say, listen, what am I prepared to risk? Maybe I'm going to risk 20 ticks, maybe I'm going to risk 15 ticks, or whatever it may be. You've got to look at that and again structure it depending on how big the move is. You obviously don't want it to go more than 50%. If you're looking for more of a swing trade from this, by all means take your high, your low, take your 20 period buy and have your stop under the 50%. Okay, it's a broader, wider stop, but obviously if you're looking for a swing trade or a whole day's move, you're going to get reward from that to make that count. So that's a very simple way of getting involved as well. 20 period moving average, wait for the tag and then get involved in that. And actually if we can see if there's anything cleaner, I don't want to cherry pick, but if we find something, you can see actually how good the 20 period is at hugging the trend sometimes, specifically on a 1 minute, and the same on a daily chart as well. It works very nicely on a daily chart. But the theory of that is it's just allowing the price to unwind a little bit. Allowing the price to unwind, you're not chasing the highs, you're giving yourself a little bit of structure. Yes, it's not perfect, but A, it stops you chasing, and B, it allows you to quantify exactly where price is relative to highs, lows, and all that kind of stuff, so that you can have a specific risk management in place, and you can kind of structure the trade around those loose boundaries. Let's look again next video at the second and third phases of a trend buying the pullback.